Hi, I'm Peter Rose, founder of Longwood Currency Trading. It's mid-March of 2024. The sun is out today. There's still snow on the ground, but we're getting there. We're getting there towards spring. I've had some email communications over the last couple of weeks, and well, the thrust of it is people are asking me how they can trade safely with high leverage, because I talk a lot about not talking to me. If you're trading at 100 or 200 or God forbid 500 to 1 leverage, I can't help you. So they're wondering what's the solution to that, because a lot of the brokers out there are offering that sort of leverage, and it's very compelling. I mean, you could take a $10,000 account and you could trade 20 or 30 lots, and there are people that can do that. But it's not you if you're asking those questions, because it means that you don't have the experience yet in order to judge the risk. You're not seeing the risk, you're only seeing the gain. We always have to look at the risk first. It's like driving a car. What's the risk? Oh, I'm gonna drive my car into a brick wall, or I'll be in a car accident and I'll get thrown through the windshield. So therefore, well, how do I mitigate that risk? Well, I learned how to drive the car safely. Yeah, but you know, there's the other thing you do is put a seatbelt on. And so you look at that and you say, well, it's uncomfortable and it does this and it restricts me from reaching over and petting the dog or whatever that thing is. It's a impingement on my personal rights as a citizen to have to wear a seatbelt. I mean, you can go on and on and on and delude yourself with all kinds of reasons why trading with high leverage is great. And there are, again, some folks that can do that, but they have the experience to do it. You'll see that a lot of the folks that are trading with high leverage are patient, and they wait, and they don't go in with the full load right away. And you might be able to trade 40 lots or 50 lots, and some of these guys are trading 100 lots on these high leverage things. But they don't go in with that full load. They go in with a small amount. And if they lose that, it's a lot of money because it's 5 or 8 or whatever lots, but they don't lose 40 or 50 lots worth. Nobody gets that entry right 100% of the time, 80% of the time. You just don't. That entry analysis that you need to do is, it's not difficult, it's simple if you have a simple rule, okay? But most folks don't have that organized way of looking at the solution of the problems of trading currencies, and so they just go, oh, you know, the Bollinger Band is doing this, and some asshole told me that, you know, the NFP was going to create this kind of effect on the price, and so therefore I'm going to go short. And here's a great place to do it. You know, your win-to-loss ratio, which is the number of winning closed trades divided by the losing trades that you have, is not just an indicator of how lucky you are, but it's an indicator of your skill at judging the correctness of your entry decision. Given the fact that you can be somewhat successful if you minimize your loss to 10 pips and are able to get 10 pips of profit when you win. So you lose 10 and you gain 10. At a 60-40 win-to-loss ratio, you're just in a situation where that kind of trading would become profitable. The question becomes, is the profitability of the trade worth the amount of risk that you have to put forward? In other words, if you're a 60-40 trader and the result of each one of the 10 trades that you make, or on a 10 trade basis, but it's 100, but if you take the number of the amount of winners that you have and subtract off the amount of losers that you have, and you divide that by the total number of trades taken, 100 trades in the 60-40 relationship, you get a per trade expectation value, right? So each trade becomes worth, I don't know, $100, let's say. Well, if you're trading $1,000 account and you trade that just a strict $1,000 100 times, and you end up making $100 on average each trade, man, that's really good. Well, what's $100 on a $1,000 account? It's a 10% gain. Well, you're not going to do that 100 times. Okay, let's just put that out of your head. But let's say that you're trading a 10 lot, and you're backing that with $70,000 or $80,000. For me, I trade at 10 to 1, and so I get $10,000 per lot. So if I'm trading 10 lots, it's $100,000. If I'm making $100 on a $100,000 risk, that's what I have to divide it by. I'm not making very much money. So the amount of risk that I'm taking for the amount of gain, even though it's at 60-40, probably isn't the best use of my $100,000. I could probably go out and buy a beat-up car or a couple of them and fix them up and sell them and make more on an average return against investment over time than I would in currency trading. You have to look at this thing reasonably as to what the risk is, and we call that in mathematics risk of ruin, or statistics risk of ruin. What's your risk of ruin? You know, in table craps, you can go to a $5 table or a 50 cents dollar table or a $20, $100 or $20, $5,000 limit that you want to bet. But there's a limit in the amount that you can bet on all of those tables. You can't just go up to the table and drop $700,000 on the table unless the table limit has a $700,000 tag on it. Or you go to the guy. There's a story about a guy that did that. He came to the casino with $700,000 in a suitcase, and he wanted to put it all on the line. And they said, "Okay, go ahead," because the odds are way in their favor. Well, he won, and they paid him off the $700,000, and out the door he went. But that's an anomaly. He's 4 standard deviations out and doing something like that. So trading at high leverage can give you great returns if you know what you're doing, if you have the experience, if the trading gods are in your favor and you don't have a bowel movement in the middle of the whole thing, or there's so many ifs in pushing all of your money to the center of the table with a high leverage, because that's what you're doing. If you have a $10,000 account and you're trading 40 lots, that's $400 a pip. Well, in 10 pips, you're gone on your $10,000. You've busted through margin. You're not going to be able to play another one. A few positions. Yes, if it goes in your favor, 10 pips, you make $4,000. Well, what are the odds? You're a 60-40 trader, or maybe you're 55-win trader. Well, look at the loss side of it. What if if you're actively trading within 100 trades? There's a significant percentage that you're going to hit 6 losers in a row. Significant percentage you're going to hit 6 winners in a row, but you don't know. So you can't count on the winners, but you can sure the hell know what's going to happen when you lose. So in 100 trades, you have a percentage likelihood that you're going to hit 6 losers in a row. If you trade 300 times, it's just about for certain you're going to get 6 losers in a row. You just do the math, okay? And if you don't understand math, what are you doing stepping up at a table that's probability driven? You're antagonizing the trading gods by trading high leverage in your Forex. There are many instances where, well, let's just put it this way. If you do the math, if you have a $10,000 account and you're trading at 200 to 1, in 6 runs you've taken that 10,000, you've run that to about $60,000. In 10 runs, and that's not unlikely that you get 10 runs in a row, or maybe you get 4 runs in a row and you take a small loss, you get 6 more runs in a row and you take a couple of small losses. But in 10 hops, positive hops, you could take a $10,000 account at 200 to 1 leverage and you'd be popping six figures. Now you take that 6 figures and you try to do that same thing and you will lose everything. Or maybe you'll go to high 6 figures. But at some point, you're trading so much money and you're trading so much heat that you'll lose it all. You're trading $2,000 a pip and you get it wrong 20 pips. That's a lot of money. You're done. So is the risk of ruin worth the high leverage? Why do we see so many people want to trade at high leverage? Because they don't want to do the work, they don't know how to study, they don't know how to look at the market, and they don't know how to trade. And so they see some jackass out there that's got a large 6-figure account and they're trading high leverage, and here's the secret thing. You're going to look at this this pattern or this system or whatever the heck it is that they're advertising that they're doing. Oh, look, I just made $40,000. Yeah, you made $40,000 because you're pushing around a 6-figure account. But you didn't push that I trade a 6-figure account. So if I've got it, I'm going to invest it. I only do 10 to 1. So I may be trading 10 lots, but I'm not going to go in 10 lots and come out 10 lots. I might do that if I have 3 lots. If I have a capability to trade 3 lots, I'll go in 3 and I'll come out 3. But if I've got 10 or 20 lots that I'm trading, I'll come in at 5 and I'll add 5 and then I'll add another 5 and mitigate my risk across that, because if you have a good win-to-loss ratio, then you're going to go the 20 pip to profit target enough times that the losses that you sustain from an initial loss, losses which are minimized and less than the initial loss that you have by doing this staging and building of, it's an art form, but it's based on statistical data as to how you manage the size of the position you have, and the size of your position should be dependent upon your bank, not on the leverage. You cannot trade on the leverage. If you're learning to trade on the leverage and you're getting used to making $1,000 a day because you can make that happen at 200 to 1, when they get around to changing the rules, what are you going to do when they limit you to 50 to 1? I mean, that's the max that you can trade in the United States, for example. What are you going to do when you have to drop from 200 to 50? You're going to be pushing it, but you don't know how to trade. You're like the guy that runs through a minefield and gets to the other side, and then he thinks he knows how to run through a minefield, so he turns around and he waves his hand to have everybody else come. And they all get their asses blown up. And you go, well, I tried to tell him how to run through the minefield. You just got lucky. Anybody that's trading high leverage without the experience and the knowledge of how to trade, how to manage the account and build it and move forward, that's fine. I go off of my 10 to 1 leverage. When I've got a runner going, I'll just load it right on, because I've got a lot of money that's been made, or in relationship to a normal win. You know, if your normal win is $100 for the day, and your position is running such that you're $200 up or $300 up for the day, and you pile that leverage on, and then you lose, that's okay, because you're only losing what you had made. So you broke even for the day, or maybe you cashed out in time to get $100. So you made your $100. You didn't get a good percentage return on your money, but you're okay. That's the way you have to learn how to play the game. It's not based on fundamentals. We don't have the resources to understand what those fundamentals and the implications of them are. It's not based on technical analysis, because the bank traders don't use technical analysis, for God's sake. All that is bullshit. And anybody who tells you differently, I got a degree in physics, almost a minor in math, 40 years of real estate investment, and there's no technicals. that are worth anything. They don't do anything for you. Use a couple of moving average lines so you get an idea of what the order flow has been over a certain period of 14 periods at 21 or 200 or whatever it is that you need to look at in order to see where the order flow is going. Trading is based on order flow. It's not based on Fibonacci levels. God forbid, there's no correlation to that. And that's why you're attracted to the high leverage, because why learn all of this stuff when you can trade 40 lots on a $8,000, $5,000 investment? And you have somebody standing over you saying, oh, follow my trades, follow my trades. And you follow them. And you get wiped out. Well, how does all this stuff work with all these people that are making the money? If you take 10 people and 5 of them you give a buy signal to and 5 of them you give a sell signal to, 5 of them are going to win. And those are the people that you advertise. I get these. Look at all these people that won based on my service. So 10 more people sign up. Now you got 15 people. So 7 of them go long, and 7 of them go short, and 7 of them fall off. Now you got these. Look, it's consistent. These people have consistently made money because if they're still in the group, they've won. It's just crazy how you can be influenced by fraud, and 90% of it is fraud. Be very careful if you're considering high leverage trading, because the dangers outweigh the phantom benefits that are there for you. My advice to you is that you learn how to trade and that you learn how to manage your money. You have risk management and you have money management. You don't even worry about money management until you get up trading 5 lots or 10 lots or something like that. Before that, it's all risk management. And if you don't understand that, or it's going to take you too long to do that, tough shit. Put your money on the line and lose it, because I'm the guy that's going to take it from you, because you are not paying attention to your risk management. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.